Hello, and welcome to today's webinar hosted by Left Brain Professionals. I'm Steve Bressler, and I'll be your host moderator today. If you need help at any time, you can email us at support@leftbrainpro.com or use the chat function within the Flow platform. Let's go over a few housekeeping items. Today's webinar is hosted on the Flow platform, and you should see a small toolbar with 4 icons in the upper right-hand corner of your browser window. The first button will mute the audio. The second button will put the webinar in full screen mode. The third button enables the chat and Q&A functions. And the fourth button enables the settings. Please enter your content questions in the Q&A panel at any time during the presentation. We'll address as many questions as we can and use the chat feature to chat with host, presenters, or other attendees. Please do not enter your content questions in the chat panel as they may get lost among other conversations. Should you have any connection or audio issues, we have a couple of solutions here for you. Turn off your VPN. Test the system using the links provided, potentially exit and re-enter the event, or try a different web browser. We've seen Chrome and Edge have both been pretty cooperative. Connect to your personal PC, phone, or tablet. If your computer is really acting up, your phone may help out. Contact the Flow support. And the last one, under the gear setting, please confirm that your camera and microphone are identified, just in case. In order to receive credit for today's presentation, you must respond to 3 of the 4 polling questions. Certificates are generated automatically and will be emailed within 48 hours after completion of the webinar. A survey will display in your browser at the end of today's webinar, and please take a few moments to answer the questions and provide feedback. The recording of today's presentation will be available on our YouTube channel, and the link will be included in a follow-up email. So thank you for your attention, and without further delay, I will turn it over to Robert for today's content.
All right, well, good afternoon, and thank you. I'd also like to welcome Suzanne. You might see her pop up or hear her later chiming in. She's relatively new to our team, and she will be at your disposal if you decide to contact us and work with us. Today's presentation is accrual versus cash basis accounting, which there's certainly some general application across all business types, but we've got a few issues that we run into with government contractors that we're going to talk about. Really quickly about us at Left Brain Professionals, we're a boutique accounting firm that works only with government contractors. We specialize in accounting systems and strategic services. Some of the tasks and projects that we get involved with are accounting system design and implementation, monthly outsourced accounting, DCAA audit support, including a lot of work with incurred cost proposals, which is still big on our plate right now, as well as CFO and controller services. Again, our team members here and our contact info. Again, the easiest way to contact us is through that support at leftbrainpro.com. Now diving into our content, at the end of our time together, we've got about 1 hour together today. You should be able to describe cash versus accrual-based accounting, define the matching principle, explain the concepts of revenue recognition, and describe the impact of accrual accounting on filing taxes. This webinar will be available for CPE credit, as Steve mentioned, and certificates will be sent within 48 hours. All right, we've got a poll question to get us started, so give me a second to launch that.
Okay, and I'll go ahead. The question reads, which is easier, cash accounting or accrual accounting? And we'll give you guys a number of seconds here to make your responses, and I see we have at about 80% responded already. And I'll give that about 5 more seconds, and we'll stop the first poll here. Okay, and is it going to show me the response?
All right, I'll stop it there. All right, and as you guys can tell, there's not necessarily any right or wrong answer. I like Mary Jean, who says depends on who you ask. The general answer we were trying to get people to is to say cash accounting is certainly easier and easier for most people to understand. But for those of us who are trained accountants, we certainly like accrual accounting and probably actually find it a little easier because we've been doing it so long. All right. Cash is easy, right? People, cash in hand, cash out of hand, right? That's what cash basis accounting is in simplest format. And so for your average small business owner who doesn't understand all the concepts of accrual accounting and dealing with matching principle and stuff that we're going to talk about today, right? What do? They recognize revenue when cash is received, and they recognize the expense when the cash is paid out. That's what cash basis accounting is. So what's accrual basis? Well, there's a whole lot more, right, with those rules to follow. Really talking about GAAP, but certainly GAAP comes into play with cash basis accounting. But if we're going to be truly GAAP compliant, right, we're going to end up with accrual based books. And it's also important to note that government contractors need to have accrual based books, especially to have an adequate accounting system, right? If you're going to pass the SF 1408, the first question on there is, are the books in compliance with GAAP, right? And are the books on an accrual basis? So GAAP are generally accepted accounting principles. It's the set of accounting rules set forth by the FASB that U.S. companies must follow when putting together financial statements. GAAP aims to improve the clarity, consistency, and comparability of the communication of financial information, right? We have a set of rules that we all follow. And that way, when we're looking at company A versus company B versus company C, if they're all doing GAAP, then we have an apples to apples comparison in how stuff is presented on the financial statements, right? And that's what this talks about. The ultimate goal of GAAP is to ensure a company's financial statements are also complete, consistent, and comparable. Part of when we talk about GAAP, and we're going to do a little bit of a deep dive on some of these items, obviously in an hour, we have limited time to get through all of the topics, but we're going to talk specifically later about revenue recognition, but we need to make sure that we're recognizing revenue when it's earned, right? That's the big thing about GAAP and accrual-based accounting is recognizing revenue when it's earned, not when I receive cash, right? Back to that cash basis accounting that we said earlier. Your small business owners, they understand, I got a check, I got a direct deposit, right? The money's in the bank, I have revenue, right? Simple and easy to look at. Well, but let's go back and look at, well, when did we actually earn the revenue? And that's what's problematic. I've got a little example that I'm going to show later, but usually, right, we've got, or often I should say, we've got net 30 terms, right, from an invoice. So for many companies, that might mean if I do the work, especially services, if I do the work in the month of June, I might not generate the invoice till the first week of July, which means I might not get paid until, the first week of August. So now all of a sudden I've got money, revenue in terms of that cash basis. I've got cash in the bank in August for work that I did in June, right? So we've got a mismatch now of when the cash is received versus when I actually earned that revenue. So that's one of the big things is being able to identify when I earned the revenue. And from a similar concept, we also have recognizing expenses when they're incurred, not when they're paid. So if I go back to the same concept, in June, I have rent, I have payroll, I have utilities, healthcare. I have maybe material purchases, travel, all kinds of expenses that happen in the month. And those expenses might actually be paid at different times, right? So if I go back, for example, and look at rent, it's possible I paid the rent on the 29th or the 30th of the prior month so that it was there on the 1st. So I might have actually paid June's rent at the end of May. So the cash may have come out in May for June rent. That wouldn't be an unrealistic situation. When we talk about payroll, well, certainly part of the payroll that got paid in June was for June work, but part of the cash for payroll in June was actually for May work, right? Because the work done at the end of May would have been paid in the first week of June. So now from a cash perspective, some of what happened in June is related to May. And now that's also going to flow through from June into July, right? That last week or 2 weeks of June, depending on what your pay period is. So the employees worked and we owed them the money as of June 30th, but we may not have paid that payroll until July 5th or 6th or something like that, right? So now we've got cash coming out in July for expenses that really were incurred in June. We also have situations where, right, what happens for those expenses that happened the last week of the month? Maybe we don't get the invoice in the mail until the first week of July, right? Are we going back and making sure that we're coding those to June, regardless again of when we're paying them? But we also have, similar to the accounts receivable aspect of, a net 30. What if we're on net 30 of paying our bills, right? We get a bill in June, we enter it in the books, we put net 30, but we pay it in July, right? If I look at cash basis account financial statements, then that cash is going to come out in July for an expense that I actually incurred in June. So there's a lot of work here that goes into making sure that we identify when the expense was incurred, when the revenue was earned, and making sure that all of these transactions are booked correctly, that they're recorded correctly in the books. There's some deeper stuff around that. There's obviously a lot of process control. There's the timing of when we're entering stuff, how we're entering it, making sure that, for example, when I get an invoice the first week of July, am I entering that with a July date? If it was a June 28th invoice, am I making sure that I enter that with the June 28th date, right? So that it's tied back to June. And then similarly, again, for the revenue, I might be, if in the case of services, which is the case for us, we invoice monthly after the month closes. So we are generating invoices the first week of July, but we date them June 30th so that the revenue shows up in the proper month, right? So those are some of the things we have to do. The last bullet here on the screen that deals with GAAP, and again, we're not going to get through all aspects of GAAP today, just trying to highlight some common things that we run across, especially with small businesses, is making sure that we're disclosing all of the liabilities, right? That's one of the big things with GAAP. It goes back to, do we have books? Let me see if I can go back here. Making sure that we have financial statements that are complete, consistent, and comparable. Well, complete means that I'm properly disclosing all of those liabilities. And one of the common ones that we come across is the PTO liability and expense, right? So remember that if you have a PTO if you have PTO that you owe your employees, whatever that is, depending on whether you call it vacation, whether you call it PTO, doesn't matter what it is. If they've earned it and accrued it, you have a liability, and that liability needs to be properly presented on the books. And as well, making sure then that when the PTO or the vacation is used, that the transactions flow correctly through the balance sheet and not through the income statement. Again, a common issue that we come across. And then the other is lease liabilities. There was a big change in lease liabilities from a GAAP perspective a few years ago. Previously, as many of you may know, we didn't have to report all of those leases on the financial statements. And I'm not going to say that we have to report all of them now, but there's another set of rules to go through. And so many of the leases that previously would not have been depicted on the balance sheet now do need to be presented on the balance sheet. And there's some math that goes into that as well, because it's not just necessarily taking the amount of the lease. There are some other factors to consider with that. All right. There are 10 principles of GAAP. I'm just going to highlight these so we have time to get through everything today. And depending on where you go, because I know when I was updating my research for the presentation this week, you might see some different terms. So the semantics might be slightly different but it's the same principles that you'll find. So we have the economic entity principle, meaning that I'm looking at the entity itself. I'm looking at one entity as a whole. If we've got other legal entities, they are their own entity, right? We have to look at them separately. Our monetary unit, we're looking at US dollars, right, for the stuff that we do. The time period is, typically our financial statements are for a year, but we could be in a situation where we're doing a 4-week period. We might be doing the 4, 4, or 5 financial statements. We might be doing quarterly, right? So just identifying what that time period is. Cost principle, that we're reporting something at the historical cost. That's the amount that we can objectively verify. Full disclosure, right, goes back to what I was saying with the liabilities, right? We got to make sure that we're putting all of the relevant and material information on the financial statements, because other people are using these, they're evaluating them, right, and they're relying on the information that's in there. Going concern principle, right? That's always something that's in an audit report. Got to make sure that the entity that we're reporting on, right, has the ability to continue, right? Do they have enough cash and other assets to continue operating? The number 7 matching principle and number 8 revenue recognition principle are two that this is the two that I chose that we're going to do a little deeper dive in. Again, it's the two that we see a lot. We see problems with a lot of these, to be honest, but these are areas that we see particular problems, and it's the ones that are probably easiest for most people to understand. Matching principle at a high level is making sure that when I'm recognizing the revenue, I'm also recognizing the expenses associated with that. And again, I've got a visual to show you on the screen. The revenue recognition is making sure that the revenue, that we are recognizing the revenue when we're supposed to, and the proper amount of revenue. Materiality is identifying if it's an amount that would impact somebody's evaluation of the financial statements. And so materiality is not necessarily a set dollar amount, right? Because $10,000 for one company might be a material number, but there are companies that we work with that $50,000 is still immaterial for that company, right? So we can't just look and say, oh, well, it's a $50,000 issue, I'm going to ignore it. I mean, if we're talking a $100 million company, $50,000 might be immaterial. If we're talking about $1 million company, $50,000 is probably pretty immaterial, right? And then the conservatism principle is that as CPAs, as accountants, we want to make sure that we are not overstating income, right? We would rather understate revenue and overstate expenses rather than the opposite, right? And give somebody a misguidance by overstating income. All right, a polling question here. So let me launch this for Steve.
Okay. Which GAAP principle addresses the relative value of an item or account to the larger set of financial statements? Economic entity principle, the cost principle, the materiality principle, or the conservatism principle? We got about half of you responded. We'll give you some time to think about that, and we'll see where the general consensus lands. Okay, we're going to go ahead and do about 5 more seconds before we close the poll. A large portion of the audience has replied.
All right, I'm going to close that out. So the answer here was the materiality principle, right? It's the relative value of an item or account to the larger set of financial statements. And I should here take a moment and further expand. When we talk about materiality, we are talking about in terms of an individual transaction or amount, as well as an entire account to the financial statements. So for example, if I'm analyzing a particular account, and let's say that account had $100,000 of cost in it, And maybe within that account there was a $20,000 variance. There was something that we couldn't clarify $20,000 for some reason. Well, $20,000 as compared to that account is material to that particular account, but $20,000 to the overall financial statements might be immaterial. So we oftentimes need to look at both to make a determination of how far do we go. And I want to take this to another extreme, is that and the perfectionist in me that I don't like to admit exists would love to always have a financial statements that tie out to the penny, right? That the bank ties to the penny, that we never have variances. I think all of my hardcore accounting friends on here, right? That's the place that it's our happy place, right? We would love to live, but it's not reality, right? Things happen, and sometimes there's just something we can't reconcile or we can't identify. I have seen people spend hours and hours chasing literally pennies, 5 cents, 10 cents, right? And maybe even more than that. Maybe where they're spending hours chasing $2,000 or $3,000. We have to take some of that into consideration again to this concept of materiality. Are we going to spend more time and effort trying to find and resolve something than maybe there's a little or no impact overall to the financial statements and what somebody's going to glean from those financial statements? All right, back to our slides here. Now, in reality, what we often come across with a number of small businesses is a hybrid approach. Now, this is unofficial. This is Robert's terminology. There is no such thing as an acceptable hybrid approach to accounting. You can't take part cash and part accrual and say, hey, we're going to do the hybrid approach. Let me be clear again. This is not an acceptable approach, but this is reality. This is what we come across quite often with many small businesses. And I call it this hybrid approach because when we look at the balance sheet, we'll usually see things like accounts receivable and accounts payable, right? That gives me an indication there's some type of accrual going on. And oftentimes they are, right? They're entering invoices. And so they haven't been paid. So it goes to accounts receivable, and that makes sense. And they're entering payables, and they're entering vendor bills, and they're remaining on the books because they haven't been paid. So they go to accounts payable. So that makes sense. But the reality is that when I look at the income statement side, what we're discovering is that they're recognizing the revenue and recognizing those expenses on a cash basis, but they're reporting them on the balance sheet as if it's an accrual. And so we've got a disconnect there, right? We can't really say that it's accrual-based accounting if in reality I'm still recognizing the expense or the revenue from a cash perspective. So again, not an acceptable approach, but this is a reality. And my guess is, if I could ask you guys to raise hands or make that as the next time I present this, I'll put it as a poll question. My guess is there's a number of you on here that's the reality of what your books look like. Or if you're another accountant or firm, you're probably dealing with clients who have the same thing as well. And in addition to this, not only what we find is kind of this hybrid approach, but obviously we find a number of businesses who are not following all of the principles of GAAP. They're not doing the things they're supposed to. For example, back to that PTO calculation and making sure that that's presented correctly on the balance sheet. So now let me dive in and talk about this matching principle. This is a big one. Again, I've got a couple of visuals here in the next couple of slides. So matching means that I'm matching the revenue and the expenses in two ways: to the period, back to from an accrual perspective, that I'm recognizing the revenue when it's earned, and I'm recognizing the expense when it's incurred. And if I do that, I should, number 2 bullet there should come in line, right? I should actually have the expenses that are associated with the revenue now lined up in the same reporting period. Now, this gets a little tricky, especially for products. It can be tricky for services. We do see this play out. And let me give you a couple of examples before I do my samples here. So in our world, it's very easy because we deliver services in the month. We have payroll in the month. We do an accrual at the end of the month to make sure that we're moving the labor, even though it might have been paid in the following month. We're moving the proper amount of labor back into the month where it was incurred. And so we do that. So from an expense perspective, all of our expenses are now in the month where they occur. And then we generate invoices from that, and we make sure that we date our invoice the last day of the month. And so now my revenue is in there. So now the money that I spent paying me and Steve and Suzanne to do the work that we billed for are now lined up, right? I've put them together. If we don't do that, what happens is we end up incurring expenses in a month, and then we do revenue another month, and things get out of whack. And with that, I'm going to go to my visual here. So my first visual here, again, could occur with a services company. We definitely see this a lot with more products. And the reason for that is oftentimes with products, it might take you 2 or 3 months to build the product that you're building and delivering. You might be buying material in advance, right? So depending on what it is that you make and how complex, you might buy materials in month 1, assemble them in month 2 and part of month 3, and deliver it in month 3. And in that particular case, if you look at the example here, that's kind of what you see, right? You see this big COGS, and this is a really simple, right? I just kind of threw some sample numbers together, but I've got COGS, January, February, March. I've got a little bit of revenue in January, February, right? But I've got this huge revenue in March. And when I look at just the first quarter of the year, I've got loss, big profit, right? And we see this many times for small businesses because they're doing cash-based accounting, right? They paid, they bought the material, they wrote a check in January, they did labor in January and February. So guess what? They paid employees, that money came out of the bank, so they recognized it, but they didn't deliver. Maybe they delivered the last week of February, maybe the first week of March, whatever it was, but they got the money in March. So now they've got this cash basis revenue all showing up in March. And again, you see this across the board throughout the year. Sometimes this gets really wonky, especially in December for companies who are like, hey, we really want to make sure, we're getting as much stuff out the door this year as possible. We want the overall revenue to be good. And so they might rush at the end of a quarter, at the end of a year to do that kind of stuff. So those could be other factors that kind of drive some of this behavior. Notice, I want you to look at the bottom part for my fringe overhead and G&A. Again, just super simplified here, but showing that, some of those expenses are relatively stable throughout the year, throughout the month. There's certainly a little bit of fluctuation, but relatively stable. And my net profit then, right, has got these big, huge swings. That causes some different problems, right? So if we're sharing this information with an investor, with a bank, right, it makes them wonder, well, what's going on, right? Why do you have these big swings? We had a client a few years ago that not only had these monthly swings, but they would have these huge year-over-year swings. And part of that would be back to just the natural cycle of this kind of stuff. But they would also have those years where they might rush to get a bunch of stuff out in December, and they would have a bunch of material expenses and payroll in November and December, sometimes a lot of overtime because they were working trying to get stuff out. So they've got all these expenses, but then they didn't get the revenue from a cash perspective. Remember, they might have shipped in December, maybe they generated an invoice in December, but they were doing cash basis accounting. They got all the revenue in January and February. And so year over year, like they would have a huge gain one year and a huge loss one year. That caused problems from a tax perspective as well, right? Because they're paying from a flow-through corporation as an S corp, they're paying taxes on it. And and one of the owners kept saying to me, he's like, "This is driving me crazy." He's like, "One year I get a huge refund, from the government because we've got this big loss, and then the next year I got to scrape together and pull together all this cash." To make big deposits because we had a great year. And he's like, this just doesn't really make any sense to me. And so when we help them fix this, their setup and get to accrual-based accounting and doing it correctly, you see something more like this example here where now things make a little more sense, right? I've got fairly steady revenue. And fairly steady COGS. I do have some few variations, right? That occurs. That's part of reality, right? There are going to be some variations, but overall it's fairly steady. And just so you guys see, I want you to look, my total revenue, COGS, everything is the same between both of them. It's a matter of, did I recognize the revenue and did I recognize the expense at the proper time, and did I match them up and line them? Now, note there in August in my example, we did have a slight loss, right? Again, some of those things happen. We have times of the year where, because of the timing of an expense, or maybe it's a slower period, or whatever the case might be, some of those things happen. We also have, and again, we've seen this, as I mentioned before, we've seen this situation where, and part of it is driven from this concept of recognizing revenue, cash versus accrual. They would have this big mental rush of thinking, well, we got to get a bunch of stuff out the door so we can get the revenue. And unfortunately, what they end up doing is expending a lot of overtime. And so they're driving up their cost. And I'm not saying to artificially get revenue, because that's not the case, but they had this misconception of what was going on. And so they're spending all of this overtime, increasing costs when maybe they didn't really have to do that. Okay. So something else to be thinking about here. And I don't want to get the impression that we're smoothing with my little air quotes. We're not trying to smooth and fudge the books anyway. We're showing, again, reality here, that we're back to recognizing the revenue when it was earned, recognizing the expenses when they were incurred, and we've lined those up into the same period, how they relate to each other. All right, let's get to our third polling question here. And let me launch this. Okay.
Okay. How often do you have swings between significant profits and significant losses? So A is monthly, B is quarterly, C is annually, and fourth option is never. You guys are off and running, and we'll give you 20 seconds or so to get all of your responses in.
All right, we'll go ahead and close this poll. Again, there's no right or wrong answer here, but always good to see what people are experiencing. Let me get back to our slides. I do see a couple of questions, so thank you for those. Make sure that if you have questions, please put them in the questions panel, and we will try to answer as many of those as we can. We will certainly have some time at the end of our slides to do that. All right, let's talk about revenue recognition. So there were a couple of particular things I wanted to talk about. So revenue recognition, recognizing revenue when it's earned. We have some very specific guidance on this. It's from ASC 606. This, again, is not a deep dive. I would tell you, certainly, if you have questions or concerns about revenue recognition, you can contact us, contact your tax CPA. There's a lot of really good information out there. I know there's some other webinars that do deeper dives on this. But the 5 basic principles here, and 5 really parts of ASC 606, is identifying the contract with the customer, identifying the performance obligation. Sounds a little, might sound easier than reality. It gets difficult when you have a fixed price contract and a statement of work that maybe have multiple things in there, right? So let's say, for example, we have a fixed price contract of $100,000 to build a house, and God, don't we all wish we could build a house for $100,000? I might have something that says I'm building a house for $100,000, Are there specific obligations though within that? Maybe part of my obligations is that I've said, well, I'm going to build a house and a garage, and maybe I'm going to do some very specific things in there. Well, do we wait to the end? And I don't have answers for you on this at the moment, but do we wait until the house is finished to recognize the full $100,000? If we finish the garage before the house, do we recognize part of the $100,000? You know, a lot of this really is dependent upon each contract. That's why it's difficult to say always, and there's black and white. There really are no bright line tests on this per se, other than, again, walking through this kind of stuff. Keep in mind that, every government contract is different. Yeah, there's a lot of similarities, but your relationship, even though you might be doing the same type of work, your contract and relationship with one customer could be very different than a contract or relationship with another customer. And so the way you recognize revenue on one contract might be different than the way you recognize revenue on another contract for the same or similar type of work. And again, a lot of that is going to be back to the obligations. Next in line with that is determining that transaction price. So if I've identified, for example, let's say I've got a $100,000 project, whatever it is, maybe there are 4 milestones in there. Well, do I take the $100,000 and divide it evenly by 4 and say that I've got $25,000 per milestone? Maybe. I mean, that might be what is logical to that contract. But it might be that one of those milestones is worth $10,000. One of those is worth $30,000. One of those is worth, another $20,000. So 10 and 30 and 20, I'm up to 60. And now my fourth milestone is worth $40,000 maybe, right? So it may not be as simple as taking $100,000 and dividing by 4. It may be something else, right? So we have to determine what the transaction price is for each of those obligations, right? Which is what takes us down to number 4, allocating that price there. And then number 5 is actually recognizing the revenue when the obligation is satisfied, right? Is the obligation satisfied because I delivered a service? Is the obligation satisfied because I delivered an item of some sort? Is it satisfied because I delivered a report, right? Depending on what it is that we're doing, the obligation might be satisfied because I have to deliver a report as the outcome, right? That could certainly be the case for accountants who are performing an audit, right? Your audit might span a couple of financial periods. So you might be, incurring expenses to execute the audit in May and June, but maybe you don't deliver the audit report until July. So now we got a situation that maybe I'm recognizing all or a portion of that revenue in July because the deliverable was the audit report. Now, that does bring up, and I should say this, I think maybe somebody kind of hinted at this in the chat, and I was thinking about it earlier. Well, what do we do? What do you do, Robert, if you've got something that says we go through this and we come up and determine, hey, on this project, I can't recognize the $100,000 until the end, because that's the right way to do it on this particular thing. The $100,000 is tied to the final delivery of whatever that final thing is. But I've incurred those expenses over a 3-month period. What do I do with those expenses in those 3 months? Right? Normally, right, we might otherwise say they would be, right, they're an expense, they're going to be on the income statement. Well, if I don't get to recognize the revenue until July, because that's when I've determined, what the obligation is and that the obligation is going to be satisfied in July, then I've got to take those expenses from May, June, and July in this example, or at least from May and June, I've got to put those to the balance sheet, right? They've got to go to some type of WIP account and be on the balance sheet, and then they're going to have to come out of WIP in July and be moved into cost of goods sold in July, so that when I have that $100,000 invoice in July that's aligned with that obligation, I now have all of the cost of goods sold associated with it flowing through to July as well, right? Otherwise, I'm going to back up a couple of slides here, so forgive me. If I don't do that, my financial statements are going to look like this, right? I'm going to have those expenses, and I'll just pick on June. Let's use the June numbers here. I'm going to pick on June here. I'm going to have expenses in April and May for which I don't have the revenue until June, right? So that's not right. In that particular case, now I didn't play that example out here. In my example here, I said, well, actually, maybe some of that revenue should have been recognized in April or May. So that's a possibility. All right, let me pause there, make sure you guys are following that. And I'm gonna go back to my other slide. We got to go back. If I look at this and I say, well, wait a minute, I've got these swings, something's not right. Let me tell you that there could be 1, 2, or potentially 3 answers here, right? It could be that maybe some of my revenue from June actually should have been recognized in April and May. That's one answer. Second answer is that maybe some of my April and May expenses should be recognized in June because that's when I got to recognize the revenue and I need to move that over there and line that up. So that's a possibility. Or third, and what is probably reality for a lot of us, it's some mixture of that, right? The reality is if I go back, and let me go back to my other slide here now. Let's go back to our criteria. If I go through here and I identify my obligations and I determine the transaction price and I figure out the allocation of that price to those obligations, if I've got multiple obligations, and many of you will in those complex government contracts where you've got a long SAL with a lot of stuff to do, you may really have multiple obligations in there, allocating that price out to those obligations. Take that process and multiply it across all of your contracts, right? The reality is you probably have some expenses that need to move to the balance sheet because you're not going to be able to invoice for them until later. And you probably have some revenue that you recognized, again, in a June or July that should have been recognized in April or May. I know it's a lot of information to digest. Give you guys a moment to think about that and to process that through. Now, let's take that and add in the complication for government contractors. This is where things get really fun and tricky for government contractors. So I'm going to put on my contract management hat for a moment and give you my little spiel as a reminder. So when you have a contract with the government directly, if you're the prime, you have a contract that's governed, usually, there are some exceptions, usually governed by the FAR, right, the Federal Acquisition Regulations. So those rules come into play as well as any FAR supplements. If you are a subcontractor or you otherwise have other commercial contracts with other entities, those contracts are governed by the UCC or the Uniform Commercial Code. Those are UCC and the FAR are two separate sets of rules, okay? Now, when we have subcontracts, it gets really confusing because the agreement is really governed by the UCC, but we take these FAR and DFAR clauses and we flow them down into that subcontract, right? So that gets a little confusing. I'll save that conversation for another day. But the reality is it's still a contract that's governed by the UCC. What's important to know about that is this concept of termination for convenience is unique to the government. Termination for convenience is unique to the FAR. Termination for convenience is not found in the UCC. And what the FAR and the UCC both do at a very high level, and I'm oversimplifying this, okay, is that when we have agreements, those agreements have to be drafted in accordance with the appropriate regulations. And in fact, what happens is if somebody leaves something out of a contract, oftentimes something comes in by default through those requirements. So for example, in the UCC, if I agree to sell Suzanne my used car and she agrees to buy it, if we just sit down as friends and write up a simple contract and she says she's going to give me $10,000 and I say, okay, and we put the VIN number and description down there and we go on and we don't address warranty, and she drives it down the road and barely gets around the corner and all four wheels fall off, well, she might still have a warranty claim against me under the UCC, right? We have a contract that's now governed by the UCC, so she may have a warranty claim against me, even though we didn't address warranty in writing. Again, I don't want to get into super details. This is not about law, but just to show you that kind of stuff comes in. Termination for convenience does not exist in UCC, so it doesn't come into play. If termination for convenience, and it will be in your government contract, is really key for those subcontractors out there, most likely, and your primes should be, including a termination for convenience clause in the subcontract. They should be adding that in, right? Because they've got the termination for convenience clause in their prime contract directly with the government. So they should be including it in their subcontract with you. This ties to this whole revenue recognition thing, because what the revenue recognition says is that because you have a termination for convenience clause, and again, I'm oversimplifying here, the government agrees to reimburse reasonable, allocable, and allowable expenses related to that project and to that termination. There's little or no risk to you as the contractor. So you now have to recognize, you may be recognizing revenue at a point in time when I'm not saying that you're recognizing additional revenue. Let me be clear. You're not recognizing additional revenue, but you may be recognizing revenue at a different time in your contracts because of this termination for convenience. And specifically, the expenses should be recognized as incremental revenue. This is going to be even more confusing for my government contracting friends on the call here, or who might be listening to the recording later, who do both commercial and government work. So you might have a situation where you're recognizing, again, depending on the customer, depending on the terms of the contract, you might be performing the exact same kind of work, but recognizing the revenue one way on a government contract and a different way on a commercial contract. So hopefully that's clear to everybody, that for those of you who are doing both commercial and government work, you may be recognizing revenue differently using the same set of principles. Let me just back up a slide. We're still going to look at ASC 606, but those government contracts with the termination for convenience add that extra layer of complexity and make this a little more difficult. All right, I think and hope that that's pretty clear. We want to get through the rest of our content here. Again, get your questions in. I'll try to answer them. If you have follow-up questions, a lot of times people will kind of digest this. Send us an email, support@LeftBrainPro, and we're happy to chat with you about it. So this practical application here on the complication for GovCon, it's not an issue for services that are delivered and invoiced within the month, right? Because my cost is here, my revenue is here. There's nothing for me to do different because I'm invoicing for what I delivered in that month and my cost and the associated cost. It's not necessarily an issue for items that were purchased and manufactured and delivered within the month. So I will say that for manufacturing stuff, even assembly, right? Or even pass-through kind of stuff. If you're buying materials and delivering them, doing drop ship or other stuff, it can still be problematic because, right, we're incurring the expense in one month, it's being delivered and revenue recognized in another month. So we're going to have to find a way to deal with that conceptually through WIP, right? So through some type of basic WIP process. If you've got contracts that have milestone or other long-term contracts with some type of what I'm calling sporadic billing, or maybe there's a billing upon the final delivery. Again, my example of you might perform an audit. If you're an accounting firm, you might incur those costs in May and June, but you deliver the final report in July and the deliverable is the audit report. Well, then we might be recognizing revenue in July for that. And so I've got to find a way to deal with the cost to make sure that they get to the appropriate spot. Talk a little bit about accrual and taxes. So pass-through entities, our S-Corps, the LLCs who elect to be taxed as either a partnership or an S-Corp. The entities, pass-through entities pay tax either on a cash or an accrual basis, regardless of how the financial statements are done. And so we do see this regularly, that S-Corps and small companies will keep their books on an accrual basis, but they continue to pay taxes on a cash basis. That is okay. You can make an election to, and that is easiest, right? We go back to kind of my opening question, right? Cash basis books, cash basis tax are very easy, right? Cash in, cash out, easy to calculate. It does require some work for your tax CPA to convert those books from an accrual basis to a cash basis for the tax return. The accrual basis matches the books from a tax perspective if you do that, but it can result in paying taxes on the revenue that's earned, but cash has not been received. And part of that's going to be a timing issue and some issues in your industry and with your customers. So again, not a right or wrong answer, but just be aware. And what I'm talking about here is, let's say you have a gangbuster fourth quarter, maybe a gangbuster December. You have a lot of revenue, but maybe you don't get that cash in until the end of January, maybe into March, or maybe into February. Now your tax return, is due after that. So hopefully you're catching up, but that is a possibility that you run the risk of, again, part of that's going to be dependent on the payment terms. You run the risk that you're paying taxes on revenue that was earned, but maybe you haven't received the cash yet. The other big issue, there can be some other timing differences for, and we refer to these from a tax perspective. You either have permanent or timing differences between the books and the tax return. Some of those can be around non-deductible expenses. The big issue, this is one we constantly run into, is that people will have, and again, it ties back to this cash basis kind of stuff in a way, but they record tax depreciation on the books instead of book depreciation. So we have to make sure that we're recording book depreciation, which is straight line, okay, no acceleration. We got to make sure that's what's in the books, regardless of what's on the tax return. So there's always going to be a difference from a depreciation perspective. And again, this is probably one of the more common ones that we see, because it's easy for the tax CPA, it's easy for the business owner to say, well, what was the depreciation on the tax return? I'm just going to book that, in my QuickBooks, and now my QuickBooks matches my tax return, and they're happy with that. But the reality is that it's not reality, right? Because we've got acceleration and other things that are coming into play. Section 179, as an example, that come into play from a tax perspective that do not reflect book. Also, it gets weird when I look at somebody's books and they have not been recording depreciation throughout the year, and they have one huge depreciation expense in December, right? Because that's when they, 12/31, they book a depreciation expense after the taxes were completed. And now my December books and really my books throughout the year are distorted because I haven't been properly recording depreciation throughout the year. So with that, I want to, get to the final poll question, and then we'll do your questions. So let me launch this. Okay.
Okay. How much help do you need with accrual-based accounting or GAAP compliance? Just a little bit, a lot, or none? I've got this. And we've got about 50 folks so far replying. We'll give the rest of the group a few more, maybe 10 seconds. Make sure everyone that wants to vote gets a chance to.
Yeah, make sure that you, again, respond to at least 3 of the 4 polling questions today if you want to get credit. Unfortunately, pretty much every webinar, I get 1 or 2 people who come to me after the fact and say they didn't get a certificate. And when I go look at the records, and this is all in the system and recorded, we have to keep copies of all of this to support, if anybody comes back and question us. Unfortunately, what we find is somebody, they only responded to 1 or 2 questions. If you don't respond to the polling questions, we can't give you credit. And with that, I think we've given you enough time. I want to get to the Q&A, so we're going to close that. And let me open up the Q&A here. And Suzanne might want to jump in and help answer some of these questions. So I'm going to try. Anna says, can depreciation per GAAP and tax be the same? I would say probably not, because again, you're from a GAAP perspective for the books, it's going to be straight line depreciation, and your tax CPA, I'm quite certain, is going to be doing a accelerated depreciation and taking advantage of things like Section 179 and 168 for those other things. So you're always going to have, at the very least, a timing difference from a depreciation perspective. Is 5% of assets the accepted standard for materiality? That's a really good question. I just have to say, I don't know the answer to that. Suzanne, I don't know if you, in any audit experience, are familiar with the...
I was just talking to Steve about that. I mean, materiality is relevant to everything. So it would be hard to ever set a number and say, this is it. And every time something in the audit pops up, the materiality standard changes. So if they have a finding, you get a bigger standard. So
yeah, and I was gonna say, and it's hard to say 5% of assets, because again, are we talking, all assets, a portion of the assets? What are the assets in comparison to the total liabilities? Right. So when we look, for example, at the balance sheet as a whole, right, we have to remember we're looking at assets, liabilities, and capital. 5% of assets may or may not be a significant number in comparison to those others. And so, yeah, I'm not aware of that particular rule. I will say for the incurred cost proposal, their DCAA does have a very specific guideline on materiality. There's a very specific calculation, and we do have that calculator on our website. So if you go to leftbrainpro.com, in the tools section of the menu, there is a materiality. There's an ICP materiality. And I do believe from an audit perspective, and this again, unfortunately, is not my area of expertise, even for financial audits, that the auditors have a calculation that they're going to follow to determine what materiality is for that audit. And again, it's going to be based upon all of the information. And it looks like maybe somebody's even popped up an answer for us. We've got a question here. Is WIP considered earned income in the accrual method? The answer to that is going to be back to looking at the rules for ASC 606. And particularly, is it a government contract? Do you have that? Do you have the termination for convenience in there? Because I would say that if you have WIP on the balance sheet and it is a government contract and you have the termination for convenience, then I'm going to say most likely you are going to be earning revenue. You're going to be recognizing revenue on that WIP amount. Okay. Do we have any webinars scheduled, recorded, covering GAAP accounting for local governments? Sorry, Deborah, that's not our area of expertise. So I can't help you on local government stuff. Trying to make sure. I think I saw another question maybe. I did want to say thank you to a couple of people in the chat. I saw some good conversation over here. So thank you for that. Looks like Carrie had a question about, let me see if I can answer this. In the government space, does all revenue flow to the government agency as the customer, or is it divided on prime and subcontracts? Example, DoD funds, both prime and contracts and subcontracts. Who is the end customer? So I'm going to interpret this because this question does come up on a regular basis. We just ran into this with a client recently. They said, well, we're selling to whoever, Northrop or Boeing, or so I don't remember, it doesn't matter. We're selling to another company. It's not a government contract. And we said, oh, but yes, it is a government contract, because the ultimate customer, and you know this, that the ultimate customer at the end of the day is the government. So it's a government contract, even though you may be a sub, even though it's governed by the UCC. I saw somebody say just because the clause flows doesn't mean that the FAR does. So Mary Jean, I do appreciate that. So yeah, be very careful. We're near the top of the hour here, and I want to respect everybody's time. Do be careful. You have a lot of people, a lot of primes out there that try to flow down the kitchen sink, as I like to refer to it. So make sure that only the appropriate FAR clauses are in your contracts, and those are allowed. They can be in there from a UCC perspective. They can get confusing. You want to make sure that it's clean and straight. But just because a particular FAR clause comes down does not mean that the entire far it comes down. And I think that's what Mary Jean is trying to say, and I do appreciate that. So we are at the top of the hour. Thank you very much. We do have webinars every month. It's the second Tuesday of the month, 1 p.m. Eastern time. So I would generally say same time, same place next month. And before we hang up, I want to tell you the topic. So next month, we're talking about labor categories, salary surveys, and compliance. And yes, all of that does tie to accounting and government contractors. So thank you again for your time, and we hope to see you again next month. Take care and have a great day.